If I told you that the four letters a company uses to identify itself on a stock exchange could add or subtract billions of dollars from its market value with no connection to its actual business, you would probably tell me that's just not how markets work. Markets are rational, prices reflect information, and a ticker symbol is just an abbreviation. However, you would be wrong on all three accounts. Here's the proof. There is a phenomenon happening every day across every exchange, and it has been documented by researchers at Princeton, Pomona College, and published in the Proceedings of the National Academy of Sciences. The finding? Stocks with easy to pronounce, clever, or memorable ticker symbols consistently outperform stocks with difficult or arbitrary ones. Not by a little, by a margin that has held up across more than 3 decades of market data. Let me show you exactly what the research found and then explain the mechanism behind it, because the mechanism is the whole story. The first major study came out of Princeton in 2006. Psychologists Adam Alter and Daniel Oppenheimer published their findings in the Proceedings of the National Academy of Sciences, one of the most respected and scientific journals in the world. They analyzed IPOs on the New York Stock Exchange and the American Stock Exchange from 1990 to 2004. Their question: do stocks with more pronounceable names and ticker symbols perform differently than those with harder to pronounce ones? The answer was yes, measurably and consistently. Stocks with more fluent names outperformed those with harder names in the days immediately after the trading began. To put a dollar figure on it, $1,000 invested in the 10 most fluently named stocks that IPO'd earned $333 more dollars than $1,000 invested in the 10 least fluently named stocks in the first day of trading alone. The research was controlled for company size, industry, and country of origin. The effect held regardless. And a decade later, Gary Smith at Pomona College looked at a different angle. Not just pronounceability, but what he called clever tickers. Symbols that are actual words or that have a clear association with what the company does. Think BOOM, boom, for an explosive company, WIFI, Wi-Fi for a wireless internet provider, KOOL, cool, for a cold storage company, TUSK, Tusk, for a company called Mammoth Energy Services, XRAY, X-ray, for dental products, YUM for Yum Brands, the parent company of KFC, Pizza Hut, and Taco Bell, LUV, Love, for Southwest Airlines, which flies out of Love Field in Dallas, CAKE, Cake, for the Cheesecake Factory. Smith and his co-authors studied the performance of a portfolio of 82 clever ticker stocks from 1984 to 2005. Their compound return? 24%. The broader's market compound annual return over the same period? 12%. $1 invested in the clever ticker portfolio in 1984 grew to $104.69 by 2005. $1 in the market? $12.17. In 2019, Smith revisited the question with two new Pomona students, Naomi Baer and Eric Berry. They looked at the same clever ticker portfolio's performance from 2006 to 2018, a period that included the financial crisis, the recovery, and one of the longest bull markets in history. The clever ticker portfolio returned 13.2% compounded annually. The CRSP Total Market Index, which tracks nearly 4,000 stocks, returned 4.9%. 19 of the 22 clever ticker stocks in the study beat the overall market. Across the full 35-year period covered by both studies combined, the clever ticker portfolio produced a 20% annual return. $1 grew to $526. The market produced 9% annually. $1 grew to only 23. Before you conclude that this is the only stock picking signal you will ever need, let me explain exactly why this works, because the explanation is what makes this a behavior episode, not an investment strategy episode. The psychological concept at work here is called processing fluency. It is one of the most well-documented cognitive phenomena in all of behavioral psychology. The principle is simple. The human brain experiences a subtle but measurably positive feeling when it processes information easily. Easy to read, easy to say, easy to remember. All of these qualities generate a faint sense of pleasantness that the brain then, without realizing it, attributes to the thing itself. Think of it like a tune you can hum after one listen versus a melody in a time signature you've never encountered. The hummable tune isn't necessarily better music, it's just more fluent, more easily processed, and that ease becomes associated with the feeling of rightness, familiarity, and approval. Applied to a stock ticker, the mechanism works like this. An investor encounters a name on the screen. If that name is easy to read and easy to say, BOOM, boom, LUV, love, CAKE, cake, the brain processes it smoothly. The smooth processing generates a faint positive response. The investor has no conscious awareness that this is even happening. They are not thinking, I feel good because this name is easy to pronounce. They're just thinking, this seems like a good stock. The feeling attaches to the investment decision before rational analysis has a chance to override it. The Pomona research has described it precisely. A clever ticker symbol invokes a sense of creativity and positivity when an investor reads or hears about it. This positive feeling, and they are explicit about this, is completely unrelated to the success or relevant financial characteristics of the company. The feeling is generated by the name. The investment decision follows that feeling. There's a second mechanism layered on top of the first one: memory. Tickers that are actual words or have a clear brand association are simply easier to remember. An investor who hears about Boom on a financial podcast on Monday morning is more likely to still be thinking about Boom on Tuesday when they open their brokerage app. An investor who hears about XRQZ on the same podcast is significantly less likely to remember it 48 hours later, let alone seek it out and buy it at all. Memory drives trading volume. Trading volume drives liquidity. Liquidity drives valuation. A stock that more people can easily remember, recall, and retrieve from memory attracts more buyers, which tightens the bid-ask spread, which makes institutional investors more comfortable holding it, which drives the price higher. The whole chain starts with whether or not a retail investor can remember 4 letters. Russell James, Associate Professor of Finance at the University of Kentucky, summarized the downstream effect in plain terms. Having a company name and a ticker that investors like, that's easy to pronounce, generates more trading in the firm, improves stock liquidity, results in a larger breadth of ownership, and ultimately produces higher valuation ratios. A 2023 paper published in Science Direct took the research one level deeper and found something genuinely surprising. Companies with fluent names are actually more profitable on average than companies with disfluent names, suggesting that the name effect is not purely psychological. It may also be a weak signal of the quality of management. Managers who think carefully about how their brand is perceived externally, including something as seemingly trivial as a ticker symbol, may simply be better operators. The fluency premium and the profitability are correlated. The effect is strongest in small cap stocks and in periods of high investor sentiment, exactly the conditions where retail investor behavior has the most influence on price. So, what do we do with all of this? The first thing is to understand the scale of what the data is describing. This is not a rounding error. A 20% compound annual return versus 9% over 35 years is a difference between $1 becoming $526 and $1 becoming only 23. The gap is driven at least in part by whether or not investors can easily say the ticker out loud. That should unsettle anyone who believes markets are purely rational. The second thing to understand is what this reveals about the architecture of your own investment decisions. The processing fluency effect does not ask for your permission. It operates below the level of conscious awareness. You can know about it as you do now and still feel its pull the next time you are scrolling a list of stocks. The brain generates the positive response automatically. The question is whether you catch it before trade comes. The signal advance story is the pure, undiluted version of this. A company gained $3 billion in market value because its name shared a word with something Elon Musk recommended. There was no earnings call, no product announcement, no analyst upgrade. Just a name, a tweet, and a market full of investors whose brains were pattern matching faster than they were thinking. The lesson from the ticker fluency research is not that you should build a portfolio of stocks with catchy names. The lesson is that a meaningful portion of market pricing, especially in small cap stocks, especially around IPOs, especially during periods of high retail activity, is driven by cognitive shortcuts that have nothing to do with the underlying business. A company that is easy to remember is not necessarily a better investment, but it will attract more buyers, hold more liquidity, and trade at a higher multiple than an identical company with a harder name. And that premium is real, persistent, and has held up across 35 years of market data. The market decided. It just used the wrong information to do it. And
I'm sorry, that one got me. That's why I laughed. Nice.
Sweet.
Nice.
Sweet.
I like it.
Sweet.
Nice.
Sweet.
Boom.
Sweet.